All right, the very last practice round, and I'm going to bring this up in a PDF format so it's a little bit bigger. Sorry, I should have had that set up beforehand. Hopefully it doesn't take all day to download. I haven't even done the winner yet, so at this point I don't even know who the winner is. Fun. I'll send that out later. But in any event, what I want to do is kind of go through, you know, talk about some of the things that have happened. I may get into even a little more specifics in terms of what some teams did or didn't do, and why some things worked and maybe why some things didn't work. So, let's take a look here, and again, we kind of jump in. And first thing I'm going to look at is sales. Ooh, look at that. Really low sales. And by the way, we had a down market this year, right? I don't know if you guys noticed, but the projections were for a bad year this year. And so maybe some teams planned for that. Maybe some did not. Baldwin here with only 63 million in sales versus Ferris, 213 million. So huge difference, right, in terms of overall sales. Of course, ROE, one of those things that we score on, ranges from Chester 19.7. No, Chester sales were way less than Ferris and Erie for that matter, but still a 19.7 at the high to, of course, we had a loss for Baldwin of significance, and I find this really interesting. Andrews really propped up its contribution margin here. That's an impressive increase, and I'm anxious to kind of look at some of the things that may have led to that. Remember, I've said kind of all along that most teams have been taking kind of a middle road, and just kind of plodding along and not really pursuing strategy. Maybe this is a sign that things were about to change, and of course we're in the last practice round. So, but that's an impressive, and yet still not much leverage. In fact, really other than Ferris, and in Ferris's case, probably as much because of the emergency loan as anything. The only team that really had high leverage, and of course everybody could look at me and say, "Oh, it shows that that's not an important thing," and too high a leverage can be a risk, and that could be what happened to Ferris. My cutoff, I think, is 2.2. Baldwin's getting a little closer, so the top two teams with leverage, of course, were the worst two teams. But if you look at it that way, you're looking at it very, very wrongly. Okay, leverage is a valuable tool, and we'll talk about that again when we talk about ROE a little bit and whatnot. Okay, in fact, a lot of the questions that I've asked you guys about ROE have had to do with that. Here, just in general, if Chester's leverage was higher, its ROE would absolutely be higher as well. Okay, now how do you get your leverage higher? Mainly, it's by reducing your equity, right? Leverage is really the relationship between liabilities and equity. I think they calculate it as the relationship between assets and equity. It might be, but the effect is the same. So it's really the relationship between leverage and equity. If you've got a little higher, between liabilities and equity. If you've got a little higher liabilities, a little less equity, okay, you're going to contribute more to your ROE. Profits, we started. I said at the start, everybody was kind of even. Well, you guys have shown that you can be uneven, and we go anywhere from about 22 million down to, of course, a big negative for Baldwin. Cumulative profit, I don't spend a lot of time on. This I do. Look at that. Baldwin apparently spent a decent amount of money, probably as much as other teams, but did not get results in terms of sales. As if I'm Team Baldwin, actually, if I'm the other teams too, I'm looking at that and saying, well, why? Team Ferris, on the other hand, spent proportionately less money and got a big amount of money in sales, and yet didn't generate a profit. And so, I think what we're seeing is teams doing some things correctly, but not following through with everything. Okay, and making everything fit, because this is a big jigsaw puzzle, and you've got to make all the pieces fit in order to be successful. And here Ferris generated sales. They did a great job on their SG&A, but look at that, a miserable contribution margin. So, if I'm Ferris, why is my contribution margin so low? If I'm Baldwin, why are my sales so low? Okay. Andrews, kind of poor sales too, really, even though they had a high contribution margin. Maybe some changes in here we do see, of course, because we had 3 teams that had losses, 3 that had profits. Really just those 3 teams with positive earnings per share. We saw the stock prices kind of flatten, or in a lot of cases go down. But remember, we had a down year, right? This gets back to the leverage. See all the white space. Generally speaking, this is just general, but by the round 5, instead of white space, this is filled up. Okay. Generally speaking, I never have a team with a AAA rating. Now, you guys can be proud of your AAA ratings. There's only, I think, 3 or 4 corporations in the whole world that have AAA S&P ratings. Johnson & Johnson, I think Microsoft does. I'm not sure the other 1 or 2 corporations that might have AAA ratings. Okay. However, I'd also argue that, again, it kind of shows a lack of interest in pursuing aggressively a team strategy, which, again, no team has done. Look at the cash flow, and interestingly, I'll say this kind of in Ferris's defense. I jumped on him a little bit up there, but Ferris obviously was not playing this as an end game, right? And by the way, practice round 5 is an end game. We're going to start over everybody from scratch. Okay, everybody gets to start back exactly where you were at the beginning of practice round 1. So none of this carries forward, for better or for worse. None of this carries forward. But I'm glad to see that some teams, and we'll see it in some other areas as well. But I'm glad to see that some teams, didn't play this as if it was the last round. There's certain things that you would have done possibly, to play it as if it was the last round. One of them was you probably wouldn't invest a lot of money into plant improvements, which Ferris obviously did. Erie invested a decent amount in plant improvements. Okay. One thing about plant improvements that I don't know if I've talked enough about, but I want to kind of emphasize this, that buying capacity or buying automation, a lot of people look at that as an expense. Okay, that's not an expense. It's an exchange of assets. You're trading cash for a more fixed asset. Okay, so in terms of the effect on that year's profit or loss, it's very minor, fairly minor. What it does is it probably it definitely increases your depreciation, which is an expense. Okay, but that's a fraction of the actual cost. So if you spend $10 million on something, you're probably gonna, maybe that will affect your profit by $1 million, because you'll be able to depreciate that, and depreciation, of course, is tax deductible, so it's even less than that. Okay. On the other hand, there are some things, like spending money on marketing. Okay, that's a direct expense. Spending money on TQM, that's a direct expense. Okay, but obviously you have to weigh those. I mean, if you don't spend any money on marketing, you're probably not going to sell your stuff, and it'd be worse than spending too much money on marketing. And so it's always kind of fine-tuning those things, which we find interesting. So anyhow, we interestingly, Digby, on the other hand, had a big positive here. So did some stuff. Digby had kind of low sales. But did some stuff here in terms of generating some cash, probably, for this practice round 5. I want to jump back up here. We did see some changes in inventory. So Andrews had big increase in inventory, is what this means, and Ferris had an increase in inventory, and so it had an adverse effect on cash. Digby, on the other hand, had a huge decrease in inventory. So probably if you go back to the prior round, you'd see that Digby had a bunch of inventory, I don't have to. I can look at it right here. Digby had a bunch of inventory and obviously sold off that inventory, and that generated a very positive cash flow for Digby. Digby's probably going to win the cash flow thing, because of that, would be my guess when I actually do the score thing. So dividends paid, we see some teams paying some huge dividends. Ferris, which unfortunately had an emergency loan, still paid a pretty good-sized dividend. We do see teams buying back stock. So interesting that that's, people have, I think, heeded some of my comments about that. Is that a good strategy in the first round? Yeah, maybe. Always ask yourself this when you're buying back stock. Have you fully explored and fully invested in the things that will help your company grow and prosper and generate profit? When you have done that, then it's almost always appropriate to buy back stock. Okay, early retirement of debt. So again, we see some debt being paid off. That's fine. Retirement of current debt. Again, it's kind of like buying back stock too. If I've run out of things to invest in, okay, and this being the last round, some people may have just decided, or they had so much cash, that they had to do something with it. But if I've run out of things to invest in, then I would, buy back debt. Okay, if I've got things that I can invest in that would continue to make my company more profitable. And by the way, as a whole, your class, your competition has really done a poor job of making investments in those things that would make your team far more profitable. Okay, a very poor job. There has not been a lot of investments in things that would make your team or teams more profitable. It's been very muted. Nobody wants to step up and do some of those things. So lots of cash still, lots and lots of cash, accounts receivable. Okay, inventory, again, we see some huge inventories in Ferris and Andrews, which is not unexpected from up above. Baldwin, on the other hand, remember we said Baldwin had really low sales and they got zero inventory. So did they miss out on a lot of potential? It's possible. We'll see. As we get down here, total fixed assets. Ferris has a lot of fixed assets, down to Team Digby, right, with almost no fixed assets. But recall up here that plant improvements were positive. So Team Digby obviously sold off capacity and did some of those things. Accounts payable, current debts. Of course, Ferris had their emergency loan. Total liabilities, total equity. Yeah, kind of interesting. Look at that. Team Ferris, even though it's got the most fixed assets, it has the lowest equity. Kind of interesting. So Team Ferris has a lot of debt. Again, it would be current debt and also which would be the emergency loan. But if you looked up above, at the bonds, Team Ferris is the only team that has quite a bit of bonds outstanding. So, okay. It's other things. It's debt management and those types of things. There are other things that caused Ferris not to make a ton of money. The primary one is its contribution margin, right? If we go up and take a look at that. So still a lot of capacity. Look at Team Baldwin. Had all kinds of capacity and yet ran completely out of inventory. Interesting. Chester has all kinds of capacity remaining because they're producing just barely above its first shift. Andrews is using its capacity pretty well, and Ferris is using its capacity pretty well, but other teams less so. Okay. So glancing at this in an overview, and I've asked a few questions that I'll talk about when I talk about the assignment. I've asked a few questions in regards to this, and that's when I'll probably want to spend some more money. But one thing about I will mention this. Remember we said Andrews had a huge contribution margin, right? 45%, something like that. And I said, maybe somebody's stepping up. Maybe one team is kind of stepping up and has decided, right? So we got a huge contribution margin, and you can see big contribution margins here in both low-end products, which they got 2 in the low end, 1 in the high end. Huge contribution margin there, okay? And pretty decent ones here in the performance and traditional segments, right? Not or I'm sorry, but look at that. Compared to other teams, and certainly compared to where you started, you're seeing a ton of investment right in automation. So I would be intrigued with that. If I were competing against them. Okay. Um, you come down to the other side of that is Ferris, right? Ferris has a ton of, they sold a ton of stuff. They had by far the highest sales, but not much contribution margin, and we can see that in the traditional and low end segments. And the question is why does, Andrews have much higher? Of course, they got 2 in the low end here, so that, I'll tell you, actually, the fact that it's Able went into the low end would have made it more difficult to have a high contribution margin, and yet it did. Okay, it did use a little less overtime, but for the most part, if you take a look at Acre in the low, right, used 100% overtime, just like Feet did in the low, and yet Team Baldwin has 44% contribution margin. Team Ferris has an 11% contribution margin. Okay, so why is that? Well, here we got material and labor's 13, just about over $14, and $10, less than $10. Okay, in material and labor costs. So what are the things that make that happen? What might that mean for the future? Okay. Baldwin we talked about, interestingly, again, sold out. Chester sold out. It'd be interesting as we get down to see if they had more potential than they did actual in a lot of these categories. It's very possible that they might have. Again, low contribution margins. Chester a little bit better, right, overall, but Baker or Baldwin, very low contribution margins. So, okay. Remember we said look at Baldwin, potential here in the traditional segment, man. So actual was less than 10%. The potential looks like it was pretty close to 25%. So they gave up 15% of the market, about a 10 million unit market. So they could have sold, roughly, this back in the napkin stuff, roughly 1.5 million more units at $20, say. Wow. I don't know what its price was, $28 even. Okay, no, I'm sorry, but I was looking at Baldwin. So at $22. So what's that? $33 million that they gave up in sales there. Wow. Okay, no wonder Baldwin and Chester, on the other hand, I was worried about them because they ran out of inventory, but they actually had actual sales that were higher, taking advantage of Baldwin, right? In the low end, Baldwin gave up a little bit there, but not a bunch. No team really, took big advantage. I mean, Baldwin gave up the most, and it looks like every other team except for Digby. Digby had it even higher. That's interesting. Digby had the largest both potential and actual sales there in that particular market. Part of the reason might be you can see two products that are firmly in the low end market, and even Dixie might have had some sales in the low end. It would tell us here, not much, but a few. But 12% there and 14% there, which gave them 26% of the market, obviously up there. So interesting, yeah. Okay. Ooh, look at that. Total industry demand in the high end was 4.3 million, and we only sold 3.9. So shame. Okay, there was quite a bit of potential that didn't get met. Again, you're seeing that very few teams are even approaching the. There's no teams that are really approaching the ideal spot out here. If you go back to your situation analysis. Echo kinda is. It's as close as any, obviously, but it's still quite a ways off from what the ideal spot would be during the course of the year. Keeping in mind that we've got a dynamic customer demand during the course of the year. So you really only see these two products. Andrews and Erie have two products, Adam and Echo, that are kind of competing there. The rest of those products are kind of falling out of those markets, and obviously everybody ran out there. Same thing happened in the performance segment. So Andrews here had a huge potential. Okay, had almost as much potential as Team Erie. Okay, Ferris really took advantage. So in terms of sales, they took advantage of being able to sell some just because they were close. And Erie and Andrews, or Erie didn't. I don't know. Andrews didn't make enough, right? So Andrews gave up a lot of sales there to Team Ferris. Kind of interesting. Yeah. Every team ran out except for Dot. Dot had a few left. That's kind of interesting. I don't know why. I suppose Dot was far enough out of range for whatever reason that it wouldn't quite sell. Even though we didn't meet demand, Dot might have been far enough out of range that it just wouldn't sell. That can happen periodically. It still sold some, but it was limited into how many it would sell. And in the size, we still, same thing. We didn't meet. Okay. And Ferris again. So Ferris had a lot of sales. Okay. Even though its potential was really low. So part of one of the reasons that Ferris had the highest sales, okay, was because teams just weren't making enough to meet demand. And in this case, again, we get only 2 teams really that are even somewhat participating in here. Chester did okay, even though its product was way the heck out here, right? Okay, but really only 2 products that were. Cure. Cure was still the biggest. Look at that. Even though it's outside, it was still the biggest seller. That's really kind of interesting. I wonder how come it did so well when it was completely out of whack. It spent more on promotion and sales budget, so that was part of it. You look, for example, at here you got Fume, which had 29% of the market, but spent nothing on promotion and sales. Didn't spend anything on revising its product, but really just picking up. That's why its potential was way down here, but its actual was here, and really just picking up sales because other teams decided not to compete basically in that particular area. Especially Baldwin, and again, Baldwin gave up a lot of sales here, but also Chester and Erie. Erie in particular was up here. And Baldwin was well positioned, and it just didn't make anywhere near enough. So it's kind of interesting. Bad forecasting. So potential and actual. I don't think I asked any questions about that. We've asked quite a few, and we'll ask some more in the future. But again, really an interesting perceptual map because so many products are out of position, and so few products are, on the performance side. I would normally see several products up here battling for position. High end, see them here battling for position. Size, you'd see them by this round down here battling for position. So really, really poor positioning of products. Okay, and again, that gets back to, I think, I'll say 2 things. Really, we've got 2 basic strategies. One's low cost and one's differentiation. And so when I say that no teams are really pursuing a strategy, I should deduct 10 points for every team. It's because although this round I would say that there was at least one team that really made a push. And I'm not going to really say, I probably already have, but there was one team that really made a push, that really started to go to its strategy. And I think were the practice game to continue on, that team would really be in a great position. Okay, if the practice rounds were going to continue on, that team that made a push towards its strategy this round, it's too bad they waited until the 5th round, but that team would be in really, really good position going forward. Okay, but other than that, or aside from that, teams just aren't, teams haven't made an effort to really be low cost, nor have teams made an effort to differentiate themselves. I'm not saying that to be critical. That's kind of the way the game has gone, but I'm saying that also to tell you that if you want to win the game, if you want to be more successful, there's your advice, and it's advice I gave before the start of the first practice round, right? And don't get me wrong, that's fairly kind of consistent, usually for the first round or 2. After that, I'll see teams get a little bit more interested in pursuing a strategy. for whatever reason, maybe some teams have decided they didn't need to because they were being successful. Other teams just couldn't figure it out. I'm not sure, but we just see really finally, look at this round, a lot of investment here, okay, and we're really seeing a pickup then in productivity, okay. Chester all the way up to 113%, so would have made a huge difference and will continue to make a huge difference on their labor costs. They've got far more productive employees. They're going to have less turnover, okay, because they've invested money in recruiting, okay, those types of things. So they're going to have less turnover. Their turnover rate's lower. It's the lowest one here. Okay, that's going to save it money. And these are, again, types of things that maybe are a little bit difficult to see when you look at the income statement up there. But believe me, these things are paying huge dividends. Okay, huge dividends. Then we come down to the TQM, and this is one that this round, to invest a lot of money in TQM in the 5th round, TQM's an expense. It's a direct expense. So Andrews spent $20 million, okay, and that's $20 million then that becomes an expense. Now, that said, it's tax deductible, so we get to write off, and our tax amounts 35%, our tax rate's 35%. So immediately we get, the government pays for $7 million of that, is how some people like to look at it. But then we also, if you look at Team Andrews, they saved 10% then in their material cost this year. And they might have spent some money last year in TQM, I'm not sure. But this year they'd have saved 10% in their material cost. So if you go up and look at their material cost, Andrews didn't have a lot of sales, but so I'm guessing material cost is 30 or 40 million. So they saved 3 or 4 million there. Labor cost is similar. They saved 3 or 4 million there. Reduction in R&D cycle time. This is one that, again, you don't see it necessarily in the profit and loss, but where you'll see that is in your R&D, and that's especially important if you're a differentiator, but it can be important as well because you spend less money to move your product ahead in the timeline, if that makes sense. And reduction in administrative costs. Your administrative costs aren't all that great. Just so you know, a few $1,000,000, but still they cut those in half. So you saved 3, 6, maybe 7 million. You got 7 million in taxes, and so your initial expense that first year, it's still an expense. Don't get me wrong. It hurt Andrews this year. There's no question about that. But these percentages, if they spent not another dime more, these percentages would stay in place. And then the demand increased. Okay, now unfortunately, Andrews didn't always take advantage of that demand increase. Okay, but demand increase. So if you had a demand before that was 100 million, you would have 112 million in demand. Okay, and how that would affect the bottom line would take a lot of math, obviously, but just kind of giving you some rough ideas of how that investment in TQM works. Okay, there's kind of your rough run through and letting folks know what's kind of going on in terms of round 5, and I'll reiterate, when we start the next competitive round, all of this goes away and everybody gets back to exactly where you were at the start of the practice round. So everybody will be totally even at the start of the practice rounds. Okay, I think that's it. I'll have an assignment one a little bit later and maybe talk about the winner spreadsheet as well. So thanks.